You just retired. You did everything right. You saved diligently for decades. You built a portfolio you are proud of. You finally decided to stop working and start living life on your own terms. And then the IRS sends you a tax bill that makes your first year of retirement the most financially painful year of your entire life. This happens to thousands of retirees every single year. It is not because they did anything wrong. It is because the tax code treats your first year of retirement as a trap, and almost nobody warns you about it until the damage is already done. The average first-year retiree who falls into these traps loses between $8,000 and $25,000 more than they expected to pay in taxes, and that number climbs higher for people with larger retirement accounts or more complex income situations. If this is hitting close to home, or if you are planning to retire soon and want to protect yourself from a devastating surprise, subscribe to this channel because everything we cover here could save you thousands of dollars you would otherwise lose to mistakes that are completely avoidable. Most people approaching retirement believe that their tax situation will naturally improve once they stop working. They assume that lower income means lower taxes. That assumption feels logical, and it is completely wrong. The IRS does not reduce your tax burden just because you have reached a certain age. Instead, the IRS treats your first year of retirement as a special category with its own unique set of rules, and those rules are designed to collect as much revenue as possible from the wealth you spent a lifetime accumulating. Understanding exactly how this works is the only way to protect yourself, and that is exactly what we are going to break down right now. Let me tell you about a couple I worked with. They spent 40 years building a retirement portfolio of about $1.2 million. They did everything by the book. They maxed out their 401k contributions every year. They never took loans against their retirement accounts. They were model savers. When they retired at 65, they expected their taxes to drop because their income would be lower. What they did not expect was a tax bill of nearly $18,000 in their first year of retirement, a bill that nearly wiped out their emergency fund and forced them to delay several plans they had been dreaming about for years. They did not make a single mistake. They simply did not understand how the tax code would treat their retirement income, and that lack of understanding cost them dearly. The first way the IRS attacks your retirement income is through required minimum distributions, commonly called RMDs. These are mandatory withdrawals the government forces you to take from your traditional IRA and your 401k accounts once you reach a certain age. Here is what most people do not understand about RMDs. The IRS calculates them based on your entire account balance divided by your life expectancy. That means the more you saved, the more you are forced to withdraw, and the more of that money gets taxed at ordinary income rates that can climb as high as 37%. When you finally retire and start taking these distributions for the first time, you are pulling money out of accounts that have been growing tax-deferred for decades. Every dollar you withdraw gets added to your other income sources like Social Security and any pension payments you receive. When you add all of those income streams together, you can easily push yourself into a higher tax bracket than you expected. This is what catches people off guard. They budgeted for retirement based on what they thought their tax rate would be, and then they received a bill that was significantly higher because RMDs inflated their taxable income in ways they never anticipated. The IRS requires you to take your first RMD by April 1st of the year after you turn 73. That deadline is firm. Missing it carries a penalty equal to 25% of the amount you should have withdrawn. If you are 74 or older and you missed an RMD, that penalty jumps to 50%. These are not small fines. They are life-altering penalties that can cost you tens of thousands of dollars in a single year. Most people do not discover this rule until they are already in trouble, which is exactly why understanding it now is so important. If you found this information valuable, hit the like button so more people can protect themselves from this hidden trap. The second way the IRS makes your first year of retirement expensive involves your Social Security benefits. Most people do not realize that up to 85% of your Social Security income can be subject to federal income tax depending on your total income for the year. The IRS uses a calculation called provisional income to determine how much of your Social Security benefits get taxed. That provisional income includes not just your Social Security payments, but also your other income sources like distributions from retirement accounts, pensions, wages from part-time work, and even interest from municipal bonds. Here's where it gets really concerning for first-year retirees. Many people take their Social Security benefits early, before their full retirement age, because they want the money sooner or because they do not realize they have other options. If you take Social Security early and you also start drawing from your traditional retirement accounts in the same year, those two income sources combine to create a provisional income that could trigger taxes on the majority of your Social Security benefits. The result is that you end up paying taxes on money you already paid into the system throughout your entire working life, and you pay those taxes at rates that can feel punishing when you add them to everything else you are pulling in during that first year. Consider a real example. A retiree takes Social Security at 62 and receives $1,800 per month. In the same year, they also take a $40,000 distribution from their traditional IRA. Their provisional income calculation adds the Social Security taxable portion plus the IRA distribution. That totals $46,600, which puts them well into the range where 85% of their Social Security benefits become taxable. The IRS then takes 85% of their $21,600 annual Social Security benefit, which is $18,360, and adds it to their taxable income. That single calculation can push a retiree from a 12% bracket into a 22% bracket, resulting in thousands of dollars in additional taxes they did not anticipate. The third trap involves something that surprises almost every retiree who falls into it. If you have a deferred compensation plan, often called a 457 plan, or a non-qualified deferred compensation plan from your employer, the IRS treats those distributions in a way that can feel like a stealth tax increase. These plans allow you to delay receiving income until after you retire, and the money grows tax deferred in the meantime. When you finally receive that money in your first year of retirement, the IRS treats every single dollar as ordinary income that gets added to the top of your tax return. The problem is made worse by the fact that many employers distribute deferred compensation in a lump sum in the year you retire. That lump sum can be enormous, sometimes hundreds of thousands of dollars, and it drops on top of all your other retirement income in a single calendar year. The IRS has no sympathy for the fact that this money was earned over many years. They see it as income received in one year, and they tax it accordingly. Some retirees have seen their marginal tax rate jump to 40 or 45% simply because one large deferred compensation payment pushed them into brackets they never would have reached with their regular monthly income. The only way to avoid this trap is to plan ahead and work with a tax professional who understands how to structure these distributions strategically over multiple years, rather than accepting a lump sum that creates a tax nightmare. The fourth way the IRS catches first-year retirees is through underpayment penalties. When you were working, your employer withheld taxes from every paycheck based on your earnings. That withholding was designed to cover your tax liability throughout the year. But when you retire and you start receiving income from multiple sources like Social Security, retirement account distributions, pensions, and possibly part-time work or consulting, the IRS withholding rules become far more complicated. If you do not adjust your withholding to account for this new income mix, you can easily end up owing more in taxes than you paid in throughout the year, and the IRS charges penalties on that underpayment. This is especially dangerous for retirees who take large distributions in the first year of retirement, perhaps because they are buying a home, paying for a wedding, or handling unexpected expenses. Those large distributions trigger significant tax liability, but if you did not adjust your quarterly estimated tax payments or your withholding to cover that liability, you face penalties that can add thousands of dollars to your tax bill. The IRS charges interest on underpayments going back to the date the taxes should have been paid. That interest compounds, and it can turn a manageable tax bill into a significantly larger financial burden. Most people do not discover this until they file their return and find themselves staring at a penalty notice that adds hundreds or even thousands of dollars to what they already owe. If you are planning to retire soon, make sure you understand your withholding obligations. Adjust your estimated payments or your withholding to match your expected retirement income as early as possible in the year. This one step can save you from one of the most common and costly surprises that first-year retirees experience. The fifth trap is one that most people never see coming, and it comes from an unexpected place. Medicare? Specifically, the income-related monthly adjustment amounts, which the IRS calls IRMA. Here is how it works. Medicare Part B, which covers doctor visits and outpatient care, and Medicare Part D, which covers prescription drugs, both have monthly premiums that are adjusted based on your income. The IRS determines these adjustments using the income information from your tax return from 2 years prior. That means when you retire, your first year of Medicare premium adjustments are based on your income from the year before you retired. If you had a high-income year right before retirement, perhaps because you received a large bonus, exercised stock options, or took a significant distribution from a retirement account, that high-income figure follows you into your Medicare premiums for the following 2 years. The result is that your Medicare premiums can jump by hundreds of dollars per month simply because of income you earned before you even retired. For a couple, these premium surcharges can total over $1,000 per month in additional costs that Medicare did not mention when you enrolled. The IRS sends you a notice informing you of these higher premiums, but most people do not connect the dots between the income they earned 2 years ago and the premium they are paying today. They simply wonder why their Medicare costs are so much higher than they expected. Understanding this connection allows you to plan ahead. If you know that a high-income year is coming before you retire, you can explore strategies to manage that income in ways that reduce the resulting Medicare premium surcharge. Some retirees choose to accelerate certain expenses into a lower income year, or to manage their taxable income through strategic charitable giving or other legal tax planning techniques that keep their IRMA adjustments lower. The sixth way the IRS punishes first-year retirees is by eliminating or reducing several deductions that were available to them while they were working. This is one of the most overlooked aspects of the retirement tax trap. Many deductions that working Americans take for granted either disappear or become far less valuable once you stop earning employment income. The most significant among these is the deduction for state and local taxes, commonly called SALT. When you are working, you can deduct state and local income taxes, as well as property taxes, from your federal tax return up to a cap of $10,000. That deduction is valuable while you are earning a salary because it reduces your federal tax liability by thousands of dollars per year. But once you retire and your income drops, the value of that deduction shrinks dramatically. In some cases, if your retirement income is low enough, you might not even be able to use the deduction at all because it is limited to the amount of your taxable income. A retiree with $50,000 in taxable income who pays $8,000 in state and local taxes can only deduct $8,000, but if their taxable income drops to $30,000 in retirement, they can only deduct $30,000, and the remaining $5,000 of state tax paid becomes worthless as a deduction. The same logic applies to medical expense deductions. While you are working, you can deduct medical expenses that exceed 7.5% of your adjusted gross income. But if your income drops significantly in retirement, the floor for that deduction becomes harder to reach because it is calculated as a percentage of a smaller number. What counted as a significant deduction while you were working might count for nothing once your income shrinks. This is one of the reasons why retirees are often shocked to discover that their tax bill did not drop as much as they expected, even though their income did. The deductions they relied on simply no longer provide the same benefit. Here is a specific example to illustrate this point. A retired teacher in Texas paid $7,200 in property taxes on her home and $30,800 in state income taxes during her last year of teaching. Her federal deduction for state and local taxes was $10,000, and it saved her roughly $2,200 in federal taxes at her 22% marginal rate. The following year, she retired and her income dropped significantly. Her property taxes remained the same, but her taxable income dropped to $38,000. Now, her SALT deduction is limited to $38,000, which means she loses the benefit of $3,000 in property taxes she paid. That costs her an additional $660 in federal taxes she did not expect to owe. Small changes like this add up across multiple deduction categories and can create a tax bill that feels completely out of proportion to the actual change in her financial situation. The seventh trap involves something that happens to retirees who make one of the most common decisions of retirement. They move. Tens of thousands of retirees relocate every year, often chasing warmer climates, lower costs of living, or proximity to family. What they do not always realize is that moving to a new state can create a tax surprise that makes their first year in the new location far more expensive than they planned. Each state has its own tax rules, and those rules can interact with federal tax rules in ways that create unexpected liability. Some states tax retirement income differently than others. Some states tax Social Security benefits while others exempt them. Some states have no income tax at all, which sounds attractive until you realize that property taxes or other costs might be higher. And some states have rules that specifically target retirees who move there from high-tax states. California, for example, has special rules that can continue to tax certain retirement income from your former employer for years after you leave the state. New York has similar rules that can catch retirees who maintain connections to the state after moving elsewhere. These state tax complications can add thousands of dollars to your first year of retirement if you move without understanding the full tax picture of your destination state. A couple I advised recently moved from New York to Florida, expecting to eliminate their state income tax burden entirely. What they did not know was that New York considers retirement distributions from their former employer as still taxable in New York if they maintain any connection to the state, such as a driver's license or a bank account. They received a New York tax bill for $11,000 in their first year of retirement, a bill they had not budgeted for and did not know how to handle. They ended up paying it because fighting it would have cost more than the tax itself. This kind of surprise is completely avoidable with proper research and planning before you move. If you are planning to relocate after retirement, spend time researching the tax implications before you commit to a location. Talk to a tax professional who understands both the state you are leaving and the state you are considering. The cost of that consultation is nothing compared to the surprise tax bills you might face if you move blindly and discover too late that your new state taxes your retirement income in ways you never expected. These 7 traps share a common thread. They all catch first-year retirees by surprise because most people do not learn about them until they are already experiencing them. The tax code was not designed with your convenience in mind. It was designed to generate revenue, and the way it generates revenue from retirees is through complexity, timing, and the gap between what people expect and what actually happens. Every single one of these traps can be anticipated, planned for, and either avoided or significantly reduced with proper preparation. The key is to start thinking about your tax situation as part of your retirement planning, not after you have already retired. Work with a qualified tax professional who understands retirement income and can help you model different scenarios before you make decisions that could cost you thousands of dollars. Think about when you will take your RMDs, how you will manage your Social Security timing, whether to take lump sums or spread out distributions, how to structure your withholding or estimated payments, how to plan for Medicare premiums, and what your state tax obligations will look like if you relocate. These decisions are not optional. They are mandatory. The IRS will collect one way or another. The only question is whether you pay what they want to take, or whether you find legal ways to keep more of your own money in your pocket where it belongs. If you want more videos covering retirement mistakes, tax traps, and money-saving strategies, subscribe and hit the notification bell so you never miss a video that could save you thousands of dollars. Your first year of retirement should be a celebration of everything you worked for. It should not be a financial shock that derails your plans and forces you to scramble for money you did not know you owed. The difference between those two outcomes comes down to knowledge and preparation. Now you have the knowledge. What you do with it determines whether your retirement starts smoothly or expensively. Make the decision to protect yourself today. Your future self will thank you for it. Think about this for a moment. Every year you spend in retirement is a year the IRS will take from you one way or another. The question is never whether they will get theirs. The question is whether you will be smart enough to minimize what they take. If this video helped you see something you had not seen before, share it with someone you care about who is approaching retirement or already in their first year of retirement. They need this information just as much as you did. And subscribe so we can continue bringing you the kind of financial education that protects your money and your future.